Hello, good afternoon. Thank you for joining us today. If you are looking for the Mariner Wealth Advisors webinar on income and estate tax planning in the Biden administration, you found yourself in the right place. Thanks again for joining us today. We're really excited. We have a fantastic panel of experts to join us on these topics today. We'll be talking about proposed changes to both income and estate taxes in the new year and with the new administration. We'll also review some of the potential planning opportunities that are likely to arise as a result of those. My name is Andrew Welzel. I'm a managing director and senior wealth advisor in Mariner's El Segundo office. I work closely with Geoffrey Bremer and his team to bring to bear the various resources that Mariner has available. Before I introduce our other panelists, I'd like to have them say a few words about themselves, a couple of housekeeping items. We're planning on somewhere around 40 to 45 minutes of the panelists talking about the various issues and discussing some of those planning opportunities. Throughout, if there are any questions, in the upper right-hand corner, you'll see a question box. Please submit those questions. I'll be monitoring them throughout the webinar. I'll bring them up at the appropriate point, and we'll certainly have reserved some time at the end of the webinar to address those. Without further ado, an introduction to our panelists. As a guest to our webinar today, I'd like to introduce first and foremost Bill Weintraub. Bill is an estate and tax attorney. He's a co-founder of the law firm of Elkins, Kalt, and Weintraub. Jeff and I have had the pleasure to work with Bill over the decades with many of our clients putting together solid estate and tax plans. Bill, a few words.
Thank you for that, Andrew. Welcome, everybody. A little bit odd, we can't see each other. It's not like a live seminar where you can see the faces, but by way of introduction, I've been in practice for more years than I can count. Most of my practice is in estate planning and related transactional tax planning, often for families and family businesses. Typically, the planning is coordinated with their entities, whether they're S Corps or LLCs. I've been doing this for a long time, and the other part of the practice is sort of the back end of it. What happens afterwards when we have a plan and someone has passed away, then we have to deal with trust administration. But being familiar with what goes on in trust administration helps us in the drafting, because one of the goals is just to make sure things move smoothly. We try to draft in a way to avoid conflict so that when we go through the process, it's real simple and easy and not a lot of complication. So with that, I know that Andrew wants me to talk about the potential changes in the tax law that we may see with the Biden administration. And I think that to sort of set the stage, I'll briefly talk about what we expect to change from where we are today. And the main change that we're looking at is the amount that can pass free of tax, what we call the exemption amount. It's a cumulative lifetime amount that people can use to make gifts during their lifetime. Whatever portion of that they haven't used is available upon death. And if we were talking about 2021, the exemption amount today for each individual is $11.7 million, or for a married couple, that's $23.4 million. Now, often when clients ask the question, is that $11.7 million for each of my children? And the answer is no. It's each individual has $11.7 million that they can transfer free of tax and spread that out any particular way that they want. And $11.7 million is an odd number. We got here because the exemption amount are set. I won't go through the whole long history, but it was set in 2010 at $5 million, and it was indexed to go up a little bit every year. By 2018, it was scheduled to be $5.6 million. With the Trump tax legislation, they attempted to eliminate the estate tax and realized that that's just not politically acceptable. So what they did was they doubled the exemption. So in 2018, instead of being 5.6, it went to 11,180,000, almost 11.2. And with the indexing in 2019, it went to 11.4 million. In 2020, 11,580,000, and this year 11.7. Under that Trump bill, the doubling effect goes away after the year 2025. So if there were no other changes, the exemption amount that would be available in 2026 would be what the 5 million from 2010 would be with indexing. My guess is that means it will be somewhere around 7 million. But I think the chances of getting from here to there without a change are small because Biden, when he was running, had a tax proposal. They haven't introduced specific legislation yet, but there are several key aspects of the Biden proposal that we expect that they will attempt to enact into the law. What will eventually pass, we don't know. If they pass anything, when it would become effective, we don't know. So everything I'm about to describe is sort of what we think. Some of it may happen, but nobody is sure if it will happen, and if it does happen, what the effective date will be. The effective date is relevant because at the end of last year, a lot of people anticipating the changes were in a hurry to use their exemption in 2020. And so for many people, we did that. Now we're in 2021, and the feeling is, well, they haven't introduced tax legislation yet. If they're going to do something, it's probably going to be effective later in the year or next year. So a lot of clients are still looking at the opportunity to use the higher amounts of exemptions. And the reason I say higher is because the Biden proposal would reduce the exemption amount to what it happened to be in 2009, which is $3.5 million for each individual. So that's a reduction of over $8 million. And so a lot of clients are looking at, gee, I could transfer $8 million free of tax if I do something now versus waiting, I may lose that opportunity. So it's a sort of use it or lose it. And in reality, that it's the transfer wealth of not just 8 million, if somebody did transfer that, but it's all of the future appreciation on that will also escape the future estate tax. So that's the highlight of what people are looking for, is the reduced exemption. But there's other pieces, the two other key pieces that go with that. Number one is the proposal to increase the rate of tax that applies for any transfers that are made in excess of the exemption. So whether it's done by gift or something passes from an estate, once you've used up your exemption, the rate of tax is a flat 40% on everything. That's the current law. And under the Biden proposal, that would go to 45%. And if Senator Sanders has any say in the outcome, it will go much higher. I think under some of his proposals, it gets as high as 70% on certain larger estates. So that's just another piece of what could happen. The third is sort of is a little bit of a wild card, and it deals with what we call the step up in basis. And what that applies to is that when assets are owned during lifetime, if an individual were to sell the asset, the gain is measured by the difference between the selling price and what somebody paid for the asset, which is what we would call the tax basis. But when a beneficiary inherits an asset upon someone's death, that beneficiary gets a new, what we call stepped up basis in the asset. So they're treated for purposes of measuring their subsequent gain or loss as if they purchased that asset at a price equal to fair market value as of the date of death. And the reason for that is simply that if an asset is subject to estate tax and it had to be sold to pay the estate tax, but then there was also going to be a gain on the sale, and the beneficiary would have to also pay the income tax, there would be very little left of the proceeds of the sale of that asset, because between estate tax and the income tax, effectively a double tax, there might be 20% left, or maybe even less, depending upon state income tax rates. So we've had this step up in basis in the law for a long time. It was repealed sort of temporarily in 1976, when what could pass free of tax was really free of estate tax was very small. So it really hit hard. And in less than a year, they voted to repeal it. It was too painful. But now I can make the argument, not that I'm a favorite, but I know the argument that they will make, that there's a lot of very, very wealthy people, and think of all the children and grandchildren who inherit assets for free. And it's only a small percentage of people that inherit all these really valuable assets, and their parents never paid the estate tax. Sorry, the parents never paid the income tax because of this. They never sold it. And now with the children in the step up in basis, they too wouldn't pay the income tax. That's just too rich a benefit to give to these very fortunate people who inherited assets. And so I wouldn't be surprised if they do something in terms of the step up in basis. So those are the three major changes that they're talking about. There's two others that are sort of under study that could affect estate planning. One involves the taxation of trust. I won't go too deeply into that, but sort of a cornerstone of a lot of planning is the use of what we call grantor trust. Trust where the person who creates it is treated as the owner for income tax purposes. And that enables a lot of planning and transfers of assets. And there's talk and there's study of potentially eliminating the benefits of using grantor trust. Another potential area under study is lots of times when people create trust, they create them to last a long time. Some people refer to them as dynasty trust or as perpetual trust. Now, in states like California, we can't keep trust going forever. There are rules that limit how long we can keep assets in trust. And as it works out, it's generally somewhere between 90 and 100 years. And for some people with large wealth, they would like their assets to remain in trust for much longer than that. While the assets remain in trust, they're generally not going to be subject to anybody's estate tax. So some people set up lifetime or dynasty trusts in states like South Dakota, where Mariner has a trust company, or in other states which don't have what we call the rule against perpetuities. And so a lot of big wealth is being socked away in these long-term trusts. And if they were able to change the rules so that people eventually had to force distributions out of trust, those assets would then be subject to estate tax. And one final topic that I'll talk about for now, it's not federal directly, but it's the way California treats trust. And Jadin's going to talk a little bit more about taxation of trust, but one item in particular that is going to be proposed in California. For people who have used up all of the exemption and can't make any more tax-free gifts, a common technique would be to make a gift to an irrevocable trust that wasn't treated as a taxable gift because of certain powers that it just wasn't a gift. But they set it up in another state, in a state where the income of that trust would not be taxed. So a number of Californians would set up these trusts in other states. Delaware popularized them, and they became known by the acronym DINGS, standing for Delaware Incomplete Non-Grantor Trust. It's a lot of words, but they're very effective for people who wanted to have large amounts of income or a gain on a sale of a big asset, avoid California tax. And several years ago, New York solved the problem of these DINGs by simply saying, we're going to treat them as grantor trust, meaning that the person who set them up is going to be treated as the owner of the asset, and they have to pay the income tax on the gain. You can't park the income in a state where there's no income tax. And California now is considering a proposal to do the same thing. And it's hard for me to imagine a constituency in California that's going to come forward and say, no, you can't do that. You have to preserve our right to avoid California tax, especially on these really large gains that only a few of us are lucky enough to have. So that's something to look for in California. But that's a very quick overview of what the changes in the law are for the estate tax. And so with that, I will turn it back to Andrew.
Bill, thank you very much. Sounds like a lot to keep track of. Jadin, as long as we're on the topic of estate taxes and trusts, I'd like to introduce you, and maybe you can talk a little bit about some of the same issues. For those who don't know him yet, Jadin Winberg is a vice president in Mariner's Estate Planning and Trust Services Group. He's also the president of Mariner Trust Company. Jadin and I have worked closely together on many clients who have irrevocable trusts and have used Mariner's Trust Services. Jadin, can you describe a little bit about Mariner's Trust Services, and then also talk about some of the issues that Bill raised here, especially the fact that Mariner's Trust Company is in South Dakota and some of the benefits that you see from that?
Sure. And good afternoon, everybody. Again, Jadin Winberg, I lead Mariner's Trust and Estate Services Group. Real quick on myself, I've been in the business for 16 years. Been with Mariner since inception of our trust company back in 2013. My background, I'm also an attorney, have a master's in tax law, is again, my educational background. But our trust company, frankly, we were formed, we're an affiliate of Mariner Wealth Advisors, and this was really client demand. So as many of you know, as Mariner clients, our advisors build really close relationships with those clients, typically over a number of years. Being in the high net worth segment, trusts are invariably part of those clients' estate plans, or should be if they're not already. And so they were looking for a mechanism to allow for the continuity of that relationship, or to ensure the continuity of that wealth advisor relationship with their next generation of beneficiaries, whether that's their kids or grandkids or whoever that might be under their estate plan. And so we created the trust company, frankly, to fill that demand and again, be a conduit where our advisors and the Mariner Wealth side can remain engaged in that relationship. We're really set up to be a private trust company offering. So it's a very personalized level of service. We don't have a big bureaucracy around things like discretionary distributions. And we typically have some flexibility, or we're willing to exercise some flexibility with maybe asset decisions or just things with a trust that might be more in a gray area, that if you're with a more traditional trust company, that, you know, it'd be something that would be hard to push through or would take a long time. And so we try to be very personalized and that private offering. We are very pragmatic, but again, we do take that fiduciary role very seriously. And so it's just kind of a blend of those kind of approaches to how we administer accounts. But again, the most important thing with us is again, that continuity of the relationship with Andrew and his team. So as you mentioned, Andrew, we've got several clients together, trust clients, and these aren't situations where we're coming in on the Mariner Trust Company side and taking over that relationship and putting a bunch of new faces around it. These are your clients. We're just in the background really supporting you in that role, making sure all the T's are crossed and the I's are dotted from an administration perspective. In terms of our charter, I think that was maybe something you had asked about, Andrew. We are a South Dakota chartered trust company, and I know Bill mentioned that. And really to explain that, maybe I'll back up a second. You know, trust situs is a concept in when you're dealing with irrevocable trust mainly. And really what that means is what state's laws govern that trust. And you can drill down into that, and that could be maybe from an income tax perspective or the taxation of that trust. It can be from an administration perspective. It could be from a legal standpoint, the validity of that document or the interpretation of various terms in that document. And so trusts typically have various, I'll call them touch points with states that can often govern whether they're subject to those states' laws for, again, whether it's tax or administration or validity. It's typically things like where the grantor, the person who created the trust, maybe lives or resided when they created it. Usually, often, where the trustee is doing the principal place of administration is going to be a factor from an administrative standpoint. Where beneficiaries live can come into play potentially from a tax perspective, though there has been some pushback on that over the last couple of years. And so, but the point is there's laws that govern this type of stuff from a trust perspective, and every state has different laws around it. And as you can imagine, some states are much more progressive in this space than others. And so when we created our trust company back in 2013, we really just looked across the country and said, where is the best place for us to be for our clients and our advisors? And that's hands down South Dakota. From a trust law standpoint, this was really a conscious effort by their legislature and influential business people to really make this an industry-leading jurisdiction and state for trust laws and really wealthy people who want to situs their trust and do business in the state of South Dakota. And so these rankings, these aren't me saying it. These are very smart people that compile rankings on these various states and industry publications that rank states in terms of their laws and, again, things, rules and regulations on what trust provisions mean and what trustees can and can't do and flexibility you might have in these documents. And so, again, this made sense for us by virtue of our South Dakota charter. Obviously, our clients and advisors have the option or we provide the means for them to get access to these South Dakota laws if and when they need it. Not all of our clients really necessarily have a beneficial need for South Dakota, or they may not care less where we are. In terms of what we do on administration, from an administrative standpoint or a day-to-day basis, a lot of times it's just governed by the document and the family dynamics and those things. But there are certainly proactive reasons that clients will reach out to us or we can leverage those South Dakota benefits. Typically it's things like asset protection. They're very progressive with their privacy. So that's something I'm seeing a lot more of over the last few years, where clients are just becoming more aware or more sensitive to information that their beneficiaries may have about these trusts that they're setting up for them. Again, asset protection is a big one. Non-judicial modification statute. So they have a wonderful statute up there. If we need to make changes to an irrevocable trust, which means a trust that by its terms you can't change. But South Dakota has, again, a statutory framework where we can do things as long as we don't alter a material purpose of the trust. But we can make, if there's a provision in there that's not workable anymore or something like that, there's just a lot of flexibility to do these things without having to go to court or without having to maybe do something more substantial, a decanting action or something like that. Directed trust statute. So we actually leverage that as part of our business model. But what that means is, in simple terms, you can bifurcate trust in South Dakota. So we can have, maybe a group or an institution like Mariner who's responsible for the administration of that trust, making sure the right information is going to the right people, maintaining files, making sure the taxes are being filed in a timely manner, those kind of administrative tasks. And then you can have other folks who might be responsible for distributions and other folks that might be responsible for the investment management. So it's a way to really customize that relationship and that trust arrangement for those families that are looking for, more engagement and, maybe from other family members or advisors that they work with. And then, of course, finally, as Bill mentioned, dynasty trust is a big thing. So basically what that is by the terms of the document, it doesn't have a terminating event in there. And so as long as there's substantial assets that remain in that trust and they haven't depleted to a point where they're not, economical to continue, they could essentially carry on in perpetuity. And so, as you can imagine, for some of these really large family trusts and assets, that can be a really beneficial feature. So that's really, again, from a high level standpoint on our South Dakota charter, and again, why we chose it. It's kind of, I always say, you've got to be chartered somewhere as a trust company, and so why not be in the best place you can be? And so that's why we chose it.
Thank you, Jadin. That was great. Really appreciate it. Bill, I'd like to go back to you if I can. And Jeff, don't worry, we're going to get to the income tax side. Bill, I'd like to go back to you because you talked about dings and this ability to try and get some of that taxation out of California when it comes to trust situs. And you talked about a planned change in California. Have you been working with your clients to take advantage of this potential planning opportunity while it exists?
Well, the dings in the California change of law will, I think, apply to what are called incomplete gifts.
Yep.
But a lot of clients will make a completed gift using their exemption. And California has a strange and I think unique set of rules that tax trusts. So if a client wants to set up an irrevocable trust, make a gift to a trust for the benefit of children, grandchildren, If that trust has a California fiduciary, typically a trustee, then the income of the trust will be taxed in California. And it doesn't matter where the trust is set up. The trust could have been set up in New York, but if you have a California trustee, the income of the trust will be taxed in California. To avoid California taxation, you have to have two things. You have to have a trust that where the distribution to a beneficiary is not certain. It has to be contingent. So if a trust says, distribute all income to my children in California, that income will be taxed in California. But if the interest of the beneficiary is contingent, i.e., it's subject to a trustee's discretion, and that trustee, fiduciary, is in another state, then the income of the trust is not taxed until it's distributed to a California beneficiary. So in a lot of cases, you might get the benefit of deferral, and if the beneficiary, by the time they receive a distribution, has moved outside of California, you can avoid California income tax altogether. But the specific question that you asked, am I setting up DINGs this year? With the right circumstance, yes, but you'd have to have, would work if I anticipated a big liquidity event in 2021. I could set up a trust in a state outside of California if I wanted to do an incomplete gift, but I think I could still do a completed gift. But if I wanted to do the structure of, I've used up all of my exemption, but I want to defer or avoid the California tax on the gain, then that's something that I would do. I could do it very easily, I'm sure, with Mariner in South Dakota.
Excellent. Thanks, Bill. And Jeff, thank you for being patient with us. I know most of you on the phone or on the webinar know Geoff Bremer. Jeff, we're thrilled that you joined Mariner in 2020. Timing could have been better, but it's been interesting nonetheless. Similar question to you. We're in a new tax year. We know some new provisions in California tax law have come into effect. There are a lot of other proposals coming out of Washington, D.C. If you could kind of run us through some of those, highlight some of those that you think are likely to occur and some of the thoughts that we might have around that, that'd be great.
Sure, Andrew, thank you. Just to kind of bring everyone up to speed, a lot has happened over the last several years. Donald Trump was pretty active in the tax regime as far as changing things. We started off with the Secure Act, and to refresh everyone's memory under the Secure Act, some of the major things were they changed the required minimum distribution term. It used to be that when you hit 70 and a half, you had to take an RMD. That was pushed back to 72. So for some of our older clients who don't necessarily need the money, this was a nice little added benefit to them. They changed the restrictions on IRAs. Again, used to be that if you hit age 70 and a half and you were still working or had income from self-employment, you could no longer contribute to an IRA. That rule was eliminated. So if you're 80 years old and you're still working or have some self-employment income and want to throw some money into an IRA, you can now do that. One of the negatives was they changed the rules on the inherited IRA payouts. So where you used to be able to take those inherited IRAs and stretch the payouts over the beneficiary's life expectancy, which could be many, many years, that was pushed back now, and all the IRA money has to be withdrawn within a 10-year period of time. So that was a negative item. Then we came to the CARES Act. CARES Act, that brought about the stimulus payments. So some taxpayers got $1,200. If you were a family and had children, you got some additional amounts of money, all non-taxable income. So that was nice. They also suspended the required minimum distributions for 2020. So clients who had required minimum distribution or thought they had required minimum distributions in 2020 suddenly found that they didn't need to take those. Keep in mind, though, that was only for 2020. So we're now in 2021, and if you are of the age where you have to take required minimum distributions, now you're back to that requirement, and so you're not allowed to forego your required minimum distribution in 2021. Otherwise, you could face some very significant penalties. Another minor change was the deductibility of charity. Under the Trump administration, they changed a lot of the rules with regards to the itemized deductions. Obviously, the biggest one was the elimination of the SALT, state and local taxes, or the reduction of those state and local taxes to $10,000. So as a result, many of our clients found themselves no longer itemizing their deductions because their biggest deduction was their property taxes and state income taxes. As a minor, very, very minor change for 2020, if you don't itemize your deductions, you can still deduct up to $300 of charitable deductions. For 2021, that is $300 per person, so it's actually $600 for a married couple. But again, keep in mind that 2020 is $300 whether you're single or married. And then we got to the CARES Act 2, which added another $600 stimulus payment. So if you were under a certain income threshold, you got those added stimulus payments. If you did not receive your stimulus payments because your income was too high in 2020, or I'm sorry, in 2019, be sure to let us know that you didn't receive those stimulus payments, perhaps because of COVID-19 and the restrictions and all. Maybe your income was down in 2020. So if you drop below the threshold in 2020, but was above the threshold in 2019, you're eligible to receive those stimulus payments on your 2020 return as a refundable credit. So be sure to let us know about those stimulus payments, what you received and what you didn't receive, so we can be sure to properly prepare your return and hopefully get you some money back if you're eligible for it. That now brings us to the Biden administration and what he wants to do. Currently, the top tax rate is 37%. That came about again under the Trump administration. Biden wants to push that back up to the 39.6% bracket that it was pre-Trump. Now, keep in mind that some of these provisions that Biden wants to bring about are going to sunset anyway. So, for example, that 39.6% bracket, that's going to kick in 2026, even if nothing changes. And so Biden just wants to accelerate that 39.6% bracket. One of the biggest changes that Biden wants to bring about that could impact some of our higher net worth clients is the capital gains provision that Biden has talked about. We're not sure exactly how that would play out, but generally speaking, under his proposal, if you have more than $1 million of income, we don't know if that's taxable income, total income, capital gain income, so those have to be worked out. But he would like to see high net worth individuals who have capital gains taxed at their ordinary income rate. So potentially capital gains could go from a 20% rate up to a 39.6% rate. That's a huge jump for clients with some type, they're going to have a sale of a business or some other event, sale of real estate. That could be a huge tax hit for them. Keeping on the area of real estate, another proposal that Biden has talked about is the elimination of 1031 exchanges. So for our clients who have rental real estate, own commercial property, for example, and want to possibly sell it and defer the gain, under the Biden proposal, there's talk of doing away with 1031 exchanges, which would mean that all of that gain that could have been pent up for many, many years, especially if they've been rolling properties from one property to the next under qualified 1031 exchanges. Suddenly they could get hit with a huge tax bill and potentially at a very high rate if all of the provisions go through. He's talked about reducing the benefit of itemized deductions. We used to have a phase out of itemized deductions. And so there's talk of bringing back that phase out of itemized deductions. There's also talk about reducing the benefit of itemized deductions to a maximum 28% tax rate. So itemized deductions and you're in the 39.6% proposed bracket, you may not get as much bang for your buck on your itemized deductions. Now, one thing that Biden has talked about is bringing back the state and local tax deduction. Whether he'll bring that back and reinstitute the alternative minimum tax, that we don't know, because a lot of our clients who had big state and local tax deductions in the past didn't really get the full benefit of those deductions because it threw them into the alternative minimum tax. So some of our clients, even though they lost that SALT deduction, didn't get hit as badly as some would have expected because of the reduction in the alternative minimum tax. Some of the questions that have been raised are, what do I do? What's going to happen? When is it going to happen? Will it be retroactive, for example? Now, the last time we saw a retroactive tax increase was back in 1993 under the Clinton administration. So it's pretty rare that we get a retroactive tax increase, but it has happened in the past. So I don't want to tell anyone it won't happen. It was even challenged, and the Supreme Court ruled that it was constitutional to retroactively increase rates. The other thing that we have to look at is the makeup of the folks in Washington, D.C. right now. You know, we had a election and the Senate was clearly, up in the air as far as what was going to happen with that. And the Democrats won those 2 Senate seats in Georgia, so we've now got a split of 50-50. House of Representatives is strongly Democratic. So the Congress as a whole, the question is what kinds of tax rates and what kinds of tax increases are we going to see in the future? The consensus, and again, none of us have a crystal ball, but Biden's got a lot of things on his plate right now. He's dealing with a pandemic. He's dealing with the economy that's, as with every stimulus package, get further and further in the hole. So he doesn't want to do a whole lot, I don't think, that might tip the scales as far as our U.S. economy is concerned. Clearly, there is some incentive for him to raise taxes, and I think that the chances of us seeing a 39.6% tax bracket sometime in the near future are probably, I think that just because they need to raise more money to pay for everything, that may get pushed through. Some of these more aggressive tax strategies, like the increase of the capital gains rates, I think they're going to have a tougher time pushing something like that through because of the fact that we are so close with the legislators in Washington, D.C. You're going to get certainly some very, very liberal Democrats, as Bill talked about. Joe, we've got a few people that we can talk about that want to raise the tax rates to 70% probably. But then there are going to be others across on that, and the Democrats who are going to be more moderate and don't necessarily want to push things to the limit. And so in that regard, I think that we're going to see some tax changes, some minor tax increases, but hopefully the folks in Washington will be a little bit more in their decision making, and will keep things in moderation as far as what we're gonna see down the road.
Thanks, Jeff. Based on that, are there any planning strategies or anything that you're cautioning clients to take a look at right now based on what you think is more likely to happen?
Well, you said, I mean, a lot of the stuff that we're talking about these days is stuff that we talked to Bill Weintraub about, and much of what we're talking about these days is on the estate planning side, just because that's an easier sell to this country. Because remember, if we've got a $23-24 million exemption for a husband and wife, how many taxpayers are in that bracket? So it's going to be much easier for Congress to look at that and say, well, this isn't going to impact a lot of people, and so we can therefore reduce the exemption amount. And again, keep in mind that exemption amount that we're at right now is going to sunset in a few years anyway. So it may not be that much of a challenge for them to say, well, let's just speed up the clock a little bit. So from that standpoint, we've been talking a lot to clients on the estate planning side and working with Bill and his folks to make sure that our clients are taken care of. On the income tax side, again, I think we're going to see things well in advance of them actually becoming law. I think that things like the large capital gain increase and even a moderate increase in the income tax rates, I'm hoping that Congress won't push something through, as some of the past laws have been crammed through at the last possible second. I'm hoping that we won't see retroactive changes. So the bottom line is I'm hoping that we will have enough advance warning of any of these income tax changes that we plan accordingly and do things such as possibly trigger capital gains if there's talk of a large capital gain increase, or possibly taking advantage of a 1031 exchange before the 1031 exchange rules are eliminated. Got it.
So wait and see approach, and then sounds like you're trying to keep yourself busy going into year end.
Yes, season is upon us.
Thank you. Thank you guys for that broad description of where you see the lay of the land right now. We have gotten a couple of questions, and so I'd like to turn to those, unless any of you want to talk a little bit further on any of the subjects that have come up.
Andrew, I would like to just talk about a couple of things. The PPP money. Some of our clients have received PPP money, and it's very clear from the IRS that those funds are non-taxable for federal purposes. The question has always been, what is California going to do? California is not conformed to a lot of these changes, so we're always scrambling. We've got 2 sets of returns to file a lot of times for clients. California has indicated that they're possibly going to pass something within the next week or so that would allow our clients to exclude 150 or to deduct expenses of up to $150,000 associated with the PPP money. The other thing is that if you all recall, under the Obama administration, we had the healthcare directive and everyone had to have healthcare, and if you didn't, you got penalized. Under the Trump administration, he just stripped that of the teeth it had and eliminated the necessity to have health insurance for, or at least eliminated the penalty for not having health insurance. California being California, starting with 2020, they picked that up and said, California now, if you don't have health insurance, we're going to penalize you. So we need to make sure that everyone recognizes that they must have health insurance in California, or they will be looking at possibly $7,000 of penalties.
Excellent. Thanks, Jeff. By the way, PPP loans and an update on where California was on conformity was one of the questions that had come up. So thank you for addressing that.
Oh, okay.
Good insight. This one's for Bill and Jadin. You talked a little bit about trustees and Jadin especially talking about a corporate trustee. What are the benefits and pluses and minuses of personal trustees versus corporate trustees? Bill, you look like you can't wait to talk some more, so why don't you try that first?
That's often one of the big topics I have for estate planning. And there are times individuals have somebody really good to be a successor trustee. Say it's a couple, husband and wife. They may have their adult children are very capable of serving as trustees. And the selection of trustee also is a function of how long a trust has to run. But if you don't have the perfect candidate, and let me back up, people say, what does it take to be a trustee for an individual? I would say, in general, integrity and common sense, because that way, there's always people I meet can help them with the legal side of it. But a lot of times I say to clients, look, you've got an individual named as trustee. You don't want somebody serving past a certain age. And I typically say 75 or 80. One, because you won't know if they start to lose capacity. They may not show it and they may make bad decisions. And B, once somebody gets to a certain age, are they really going to have the energy and focus to do what they need to do as a trustee? So even if clients have that one person to serve as a trustee, if the trust is going to last a lifetime, very few people know a trustee that someone that can serve for the lifetime of their children. As a practical matter, that never happens. So I generally try to encourage them to designate an institutional trustee, not only just as a backup, but often as a primary trustee for several reasons. Number one, you don't have to worry about them getting too old. Number two, you don't have to worry about them making a mistake. If somebody makes a mistake, they may or may not have the resources to fix it. You're dealing with institutional trust companies, because they do this every day, the chances of them making a mistake are very small. And if they did, they can fix it. And then number three is I always worry about what I would describe as something like a Bernie Madoff situation. You have an individual trustee that had a severe financial reversal, but they're the trustee of a trust that has substantial liquid assets. They may not be able to resist the temptation to borrow for a little while from the trust with the best of intentions to repay. But what if they can't? When you have an institutional trustee, it's just these issues don't arise. Sometimes it's a problem solver, because you may have children and you may say, well, should I designate all of my children as co-trustees? Or should I just designate my oldest child? And I'll always say to them, well, if you just want to designate your oldest child, how will their siblings feel about that? Are they going to be resentful that their oldest sibling gets to make all of the decisions? And sometimes they say, yeah, they get along pretty well. I say, granted that, what about their spouses? And then everybody starts nodding and saying, yeah. The spouse is going to come and say, why did your brother do that? I bet he's up to something. How come he didn't consult with you? So for all of these reasons, I often find that, except in there are a number of cases where there are individuals, adult children, the trust isn't going to last that long. But I find that institutions work very well. And let me add one last point. It often works out to cost less, because when I have individuals serving as a trustee, their first question would be to me, Bill, what do I need to worry about if I'm the trustee? I explain their fiduciary obligations, all the things they need to do. And they say, great, you'll advise me of all of the things that I need to do. Don't worry about your legal fees, because the trust is going to pay them. And so the legal and the accounting fees run, there's investment advisory fees, and then an individual who did very little, then they also want to get in on the act and charge their own trustee fees. When I have an institutional trustee, I rarely hear from them. They know what to do. They may call me if they need a piece of information. But I find in the long run with institutions, it actually costs less with a lot less risk. So for all of those reasons, unless there's that perfect candidate, I often recommend institutions, if not as the primary successor trustee, at least as the second successor trustee.
Thanks, Bill. Jadin, understanding that you're a little biased on that particular topic, do you want to add anything or subtract?
Well, first, I should hire Bill to do business development because that was a pretty good summary. No, from my perspective, I've been in the business, so this is what I do, and I see it play out on a daily basis. I really approach it as I don't typically see an upside for an individual in that role. As Bill mentioned, it's there could be capabilities there with kids or whoever that might be, but do they have the time? Do they have the interest? Because it's really not something that you tread lightly into. And so, I find for most folks, even if they start down that road, they very soon figure out that it's not really as glamorous as they may think it would be, and they often are looking for ways to get out of it. And of course, there's exceptions to this. So again, if it's a short duration or we're not talking about a substantial sum of money, it might not make sense to be at a corporate just because of the costs and these kind of things. But by and large, certainly as the wealth of a client increases and as the duration of that trust is anticipated to be in existence, absolutely, the corporate trustee, the typical removes the family dynamics, the liability standpoint. The expertise in-house, I think, is a big thing. As Bill mentioned, we have policies and procedures to deal with things. We see stuff on a regular basis, so we know how to make decisions. I find a lot of individual trustees, and frankly, we have a lot of them at Mariner Wealth on the wealth side, who are clients of Mariner Wealth, and they're serving as trustees. And a lot of times they don't really have a lot of confidence in what they're doing. And frankly, a lot of the decision making is a gray area. Trusts often are very general in terms of maybe the standards of distribution and these kind of things. And so, for instance, if it says health, education, maintenance, and support, well, what does that mean? And so you're making these decisions really, again, in kind of this gray area, and you need to really know the risk involved and the dynamics at play and why you may do certain things over another. And a lot of that just comes with experience. Final point, I like Bill's comment on the cost. It's typically not a cost issue from my perspective, because once you piece everything together outside of a trust company that we can do in-house, it's usually a lot more cost effective. And then the one thing I see that I think gets missed or just isn't thought about as much is just the oversight. And so, frankly, when an individual is serving in that role, there's nobody watching over what they're doing other than maybe those beneficiaries. But if that trustee is not playing nice, they're not doing their job, they're not providing information, they're not investing assets, and you can't get them to change their behavior really without going to court and suing them, and it turns into this just big mess and can cost a lot of money in legal fees and these kind of things. Whereas with a corporate trustee, you've got internal compliance groups that are going to be watching what you're doing. And more importantly, we're regulated entities. So I have regulators that come in every year, and they're looking to see how we handle discretionary distributions. What kind of records are we keeping? Who are we informing of those trusts? And are we doing what we're supposed to be doing as a trustee? And if we're not doing it, we're not going to be in business very long. And so that just doesn't exist. It's really kind of the wild, wild west when you're talking about individuals serving in that role. And so, I think it's if you've got some wealth and you've got kids and grandkids that you want trust to be around, in existence for a long period of time, I certainly would recommend you hire professionals to do that. One way to kind of the sweet spot I find sometimes is a co-trustee role. And so you kind of get the best of both worlds. You have your corporate trustee who's going to be sort of the guardrails and make sure things are done correctly. But you have this individual trustee who has a lot of say-so and leverage in what's going on. And they also have the personal touch with that family that a entity, just by its nature, might not be able to have. And so that can always be a really nice compromise and in that sweet spot if families still want that touch and control with family members, but some professional guidance.
Excellent. Thank you all. No, we're almost at the top of the hour, and there are a couple of other questions, but I think we'll leave those and address those directly with the clients. I wanted to thank everybody for participating today. For me as a wealth advisor at Mariner, being able to surround myself with all of this knowledge and bring it to bear to our clients is just ideal. It's an ideal situation. And so thank you again for spending time with us. Really enjoyed working with all of you guys, and look forward to many more of these. Thank you very much. Take care.
Thank you. You're welcome.
Thank you.